Okay, so in this session, I'm going to answer a question I get very often and too often. It's not very difficult and it's actually rather easy once I explain this. We can take some questions afterwards, but basically, I get a question as to how do I know when to enter a trade? And well, the answer is simple. So when you've marked up a chart, so let's, for the purpose of this example, start marking up this chart over here. And let's say that we see that there was a large move to the upside here in USD CAD, and we saw a move then to the downside. Obviously, there was reasoning behind all of this. There was liquidity taken. The DXY had taken liquidity also, and it was bearish, and there was a move to the downside. So there was a whole narrative behind the story. But if we pay attention over here to this specific order block over here, and obviously this being a daily order block has strong orders for selling pressure for the downside. So when price comes back to this daily order block over here, we can expect further selling to take place because it is a daily time frame, obviously. So for the purpose of this example, I'm going to show you entry technique. So when this order block was created, we see this large move to the downside. So if we look at that on a daily time frame, we can also see over here that there was a gap in price to be filled, an imbalance, a liquidity void on this higher daily time frame over here. So this liquidity void had been created when price moved to the downside. An additional liquidity void was then created with further move to the downside, but obviously price had filled this liquidity void and targeted price coming back to close this liquidity void over here. It traded into this daily order block over here. And if you were looking to sell, generally when you've marked up a higher time frame, you will want to go down to a lower time frame. Well, let's just, for the sake of this as well, add ourselves from this swing high over here to this swing low over here. So this swing high to this swing low. If you know anything about trading inside the range, what I previously did a Zoom call on, you will understand this. This is the range. This is this recent swing high to the recent swing low on this H4 4-hour time frame. So a fibs is drawn from this bodies to these bodies, expecting a sell over here. Sure, this is hindsight, but I'm showing you entry technique for the purpose of this example. So we had this daily order block over here formed, which pushed price lower. It created a liquidity void on the daily chart, and we've drawn a fibs over here from the bodies of the swing low to the swing high, or rather from the swing high to the swing low, because it is bearish. So anywhere inside 62% OTE and 79% is where we are expecting price to retrace into to give us a premium price to sell at. So we know that we go down to lower time frames of 15, 30 minutes to enter a trade, especially if you are scalping or day trading. Obviously, if you swing trading, well, then you can use say a 1 hour time frame to enter your trades over here. But if we pay close attention for this specific explanation of this entry technique, when price rallied over here to this peak high, this peak formation high over here, if we apply the IPLs, we know the recent IPL over here, short price went through there with this body, but this is a 15-minute time frame. If you go look at the 30-minute time frame over here, let me just make this thicker so we can all clearly see, so there's no discrepancies here. This thick green line is the 500 institutional price level, which also happens to have closed our daily liquidity void and also has traded into this blue line, which is our daily order block that we have over here. Okay, so on that 15-minute chart, price trades into this 500 IPL over here. Okay, so we know with a fibs we pull from body to body, but for the purpose of this entry technique I'm going to show you something different. So we have this IPL over here, which is the 500 IPL, this one here, and it creates, once price comes in, touches that order block, closes the liquidity void, also comes into a higher time frame premium of 62% based on the swing high to the swing low. Here we have it touching the 500 IPL, price rejects the 500 IPL, and where does it start to rally away from? Creates these bodies over here. Okay, so price falls from our daily order block over here and starts rejecting the 500 IPL. Okay, so now because we have a higher time frame markup, we can pull another fibs on a lower time frame. But the difference here is that we are not pulling it from body to body. We are pulling it from the IPL, the institutional price level of 500, where price was rejected from. So where did price reject from here? The 500 IPL. So it's a sell. So I'll pull a bearish fibs here to where price had started to rally away from the lowest body of this move to the downside, which is this red line represented over here at the bottom. Price rallied away from there. Based on the higher time frame markup that we've done, the daily liquidity void being closed, the daily order block present, the higher 4-hour time frame showing us a premium level of selling opportunity, we are using this entry technique. If we had missed our entry or if we didn't set a sell limit, that's fine. Price gives us a second opportunity to take the trade. So this being a 500 IPL over here, price rejected this 500 IPL and price rallied from these bodies. So when you're looking for a sell opportunity on a lower time frame of 15 minutes, you will use the IPL where price rejected from to the lowest bodies of where price rallied from. So here, in this example, price rejected from the 500 IPL and rallied with the lowest bodies over here at this level, that we're not pulling from the IPL over here, we are using the bodies in this bearish example. And we can see price coming into a second opportunity once it had respected our daily order block closed, our daily liquidity void. Price gives us 62% retracement over here. And the same can be said if we are looking for a buy opportunity. This is an entry technique. This is a question I get asked always. So if we have the assumption that this level at the bottom over here is an order block, this is an order block, and I'm just going to make this one red, and let's see if there was a daily order block. So there was a daily order block over here where price had touched this daily order block over here. Okay, if we run our fibs on this higher time frame, wick to wick, remember it is a higher time frame, so we are using wick to wick. Okay, not 4 hour and low, we use bodies. Higher time frames, daily and higher, we use wicks. So from this wick of this low to these wicks of these highs, price came into a higher time frame, discount price 62%, OTE 79, came to OTE exactly. So we have this daily order block. Inside there, this 4-hour order block over here. Okay, now if we go to that same level, let's just delete all of this and I'll show you a bullish example of the entry technique. So at these levels over here, you look for the swing low IPL. Where is the swing low IPL? Over here. Here is the swing low IPL. The round number 1.31 over here. Okay. So when price rallies away from this 1.31 round number to the highest body, where's the highest body? Well, if we follow this move over here in hindsight, we can clearly see that this is the highest body. If we had pulled our fibs from the IPL to the body and we are waiting for price to come into a level of discount, we don't get that over here. But here, if we were patient, we would have gotten entry right over here in this zone, right there at 62%. Now, that's not the best discount level, but it also gives us opportunity to get in based on this 4-hour order block. So there's additional confluence. We've got a daily order block as well. So there's reason for price to go to that level over there. If we zoom in there, this dark red box over here is that IPL entry technique I've showed you to enter the trade on the 15-minute chart. From the round number IPL to the highest body is where we took our entry on the 15-minute chart over here at that same zone. Here we clearly see price rallies away from the round number to the highest body. So we are anchoring our fibs in a bullish example from the round number, because that is where price rallied away from in a bullish example to the highest body into discount. And hopefully everyone gets that entry technique. And we can look at numerous examples, but the same rules would apply. Is that whenever you have a higher time frame markup of a chart of where you're expecting price to come into, this is an entry technique. So this is how you can potentially enter a trade. So if we have the higher time frame premise that price is coming to a point of where we want to see price action coming into, let's see if we can find ourselves an entry over here. So we have a higher time frame markup. Let's actually just use the daily over here. So if we were marking up this chart and we saw this daily order block over here again, now you don't have to use a daily order block, but obviously if you mark up higher time frames, they're going to give you confluence to sell on a lower time frame. So for this purpose of this example and this entry technique, you can use higher time frames. However, you could potentially even sculpt this if you wish to. Okay, so there's our daily order block. Okay, and here on this 4-hour chart, so from this high of this body to this low over here, we see this coming into a premium area between 62 and 79%. So we can look on a 15-minute chart in that zone to sell. So now we zoom out here and we look, well, this high that was created over here has the recent IPL of this peak formation high. The closest IPL to this peak formation high is 500, it looks like it. Okay, so at 500 IPLs on this 15-minute chart, you will run your fibs as price is moving. Forget the price action that has occurred here, because we are looking to enter while price has entered our entry zone. So this is looking in hindsight over here, all of this data and price. This is where we are looking for price reaction. So all we need to do is, as price starts to reject our daily order block, our higher time frame fibs, we are using this IPL of 500 and running our fibs as price is moving down on the 15-minute for an entry. And as these candles close, you just pull down. And here on this candle, this green candle here, we can see we get entry into OTE over here. Price rallies into OTE over here. And if we caught this move, well, there's 20 pips. Well, sure, 20 pips, maybe not a lot, but it's a day trade. Who knows? Got your stop loss higher, could be a swing trade, but you always remember need to pay yourself. So not every trade plays out how you want it to play out, but this is just an entry technique. So you need to go and apply the technique to the trading style that you are trying to adopt, whether it be scalping, swinging, position trading, or day trading. This is just an entry technique based on all of the concepts we already know, applying those concepts, and this entry technique is to take you into the trade, because this, I get asked too many times how to enter a trade, and this is an entry technique. And there would be that example of that sell opportunity. Okay, so that's what I needed to explain to you all, and now you can go ahead and ask any questions if you would like. Anyone would like to start with a question? Josh.
Yeah. Hi, can you hear me?
Yeah, sure, go ahead.
All right. My question is more about psychology, I guess. It's it's like, what do you find your biggest psychological pitfall to be when you're looking at the chart?
For in general, when we like talk about traders in general, or are you talking specifically to me as to what I find a problem?
Yeah, specifically to you. Like when you're sitting down in front of the chart and you're waiting for a trade to pan out, like what's your biggest psychological I guess what's your biggest issue that you have to battle with?
Probably not taking trades. So sometimes I have an inner battle with myself as to should I take this trade because I've already taken a trade, and I'm specifically speaking about scalping because I have a personal rule where I don't generally take more than 2 scalps a day. And sometimes there's trades that I identify on the chart where I'm scalping, and they bring to me the same signal as if I want to buy and sell as all my other scalps, but I fight the battle with myself to not take that trade because I have already traded. So I'm sticking to my plan by not taking that trade. Even if the plan works out or it didn't work out, I still journal that trade. I take a screenshot of it. I say what was going to happen. If it happens or if it doesn't happen, I've still got the screenshot. I've still got my description of what I anticipated the trade to do. So I'm still in the market as such in my head, even though I'm not physically in the market. So that's also something that a lot of other people battle with, is either they're not doing this or they're just trading because they see the setup. And if they are sticking to their trading plan by, if they've already taken 1 or 2 trades for the day and their rules in their trading plan state that I'm only going to take 1 or 2 trades per day, then they're not going to just take the 3rd trade because they are sticking to their rules, and that is what works. So for me, even if I see an awesome setup, I still won't take it. And I have to fight that battle in my head to not take that trade because I'm sticking to my trading plan. No matter how sweet the trade looks, I don't take it.
Thank you very much.
How about for you? What is your biggest challenge for psychology?
I think it's greed, because a lot of times I'm in profitable positions, and I just want the next, and like a little bit more, just a little bit more, and it'll cause me to like accept more risk than I should, and that's my biggest problem.
And do you find yourself taking the trade anyway, or do you hold your?
Yeah, yeah, I do. I do. Or like not exiting early enough. Like according to my plan, like I try to like exit after I get 20 pips. And so a lot of times I have the 20 pips, I see it, and it'll be like 30, 40, and I just keep letting it go because I want more. So I really have to work on my greed.
Oh, well, each to their own. Every person battles with a different psychological problem when they're trading because each characteristic of each individual is different. So no one problem is global or generic to everyone. It's everyone has their inner battles with himself. But I would recommend, if you haven't already, is go and watch those psychological videos I posted. I think it was last week Saturday. They are a real helper in terms of the psychology and emotional part of trading, because that is where the downfall of most traders are, is that it's not the strategy itself, it's not the entry, it's not the exit, it's not the setup, it's the fact that I'm either over trading or I have some emotional issue or I'm fearful of taking risk, and then I don't even enter the trade anyway.
Thank you very much.
Muhammad, you ask for a swing, what's the stop loss in pips? Mohammed, there's no one word answer, unfortunately, to that, because it depends on what your expectations of the trade are. So, for example, let's say that this was your swing setup and you are looking for an entry to take USD CHF to the downside. So, based on a higher time frame analysis, because it's a swing trade, you could determine where your stop loss would be based on the market price. So what do I mean by that is, well, if you look, this is the order block we are expecting reaction of. And generally, if price exceeds and trades above and closes above an order block, well, then it's going to make the trade invalid. So if you are looking to place a stop loss, let's say you wanted to take USD CHF to the downside to possibly target these equal lows over here. As we can see, this is pretty much equal lows over there on this closing price. Notice I'm using closing price as well, and not only wicks as liquidity, as well as closing price. So there's equal lows, and if you are selling over here, you could target so if you sold over here, a 125 pip target with, say, a 40 to 50 pip stop loss. It would really determine of what your expectations of the trade are, because if you want to risk 1 to 1, well, then that's not a really good risk reward. But if you're risking 1 to 2 or 1 to 3 or 1 to 4, well, then where is the trade going to? 125 pips thereabout, or let's say 100 plus. Well, if you're going to use a 50 pip stop loss, at least it's a 1 to 2. So if you're going to use a 50 pip stop loss on the swing trade and you entered with that entry technique and you had other confirmations, you could put your stop loss anywhere above this order block over here, which would work out possibly less than about 50 pips, so about 45 pips or so over here to take price to the downside if you were in a swing setup. Okay, so hopefully that answers your question about swing as to where your stop loss. It all depends. The stop loss depends on if you're scalping, if you're day trading, if you're swinging, if you position. So obviously, the longer you're going to be in the trade, you might want to have a bigger stop loss because the price action may change throughout the day based on what is occurring in the marketplace. But you need to have a higher time frame analysis if you are going to swing. You cannot swing off of a 15-minute chart, unfortunately. Okay, there's another question here. Why would price trade beyond a breaker and reach for an OB instead? Is there a rule or reason why this happens? So if you go to my teachings, Sprinslu, who asked that question, we know that, okay, let's just look here for a peak high over here, or a swing low, or some sort of confirmation on a 4-hour if we follow an order flow. Okay, so when we have price, over here is possibly a better example. Okay, so when we have price making a breaker, okay, let's say this is our breaker over here, for example. Okay, there's our breaker. When a break is created, it obviously has to trade through and price has to close above the order block to create the breaker. It doesn't mean because the breaker is traded through that the breaker is invalid. This is part of the strategy, is that the breaker and the source can be tested. So if we look at this area of price, let's say, right, basically this here is our source over here. So this candle to the downside is our source. So the source is created, the breaker is closed above, so that's what's made this order block the breaker. Price rallied up and came back into and closed below our breaker here. It is still a valid setup based on the order flow strategy that price can come in to retest the breaker and retest the source. So price can even come beyond the source as long as price closes inside of the source candle. The order flow is still valid in the opposite direction. So it's still bullish, even if price comes into the source. It can retest the breaker, it can retest the source, as long as it does not close below the source or above the source if it's a bearish example. So that will answer your question. Also, it is in the order flow strategy on YouTube, so you should be able to find the answer there. Hopefully that answers your question. Okay, so can you give a quick overview of different liquidities and what makes them different? When entering on an OTE, where should the stop loss be? Again, Michael, for that question of OTE, it depends on the outcome of the trade as to where your stop loss will be. If you are entering off an OTE and you're scalping, well, then 15, 30 pips for the day trade is fine. If you're swinging off an OT off a higher time frame, then your stop loss might want to be a bit bigger. It really depends on your expectations of the trade. Okay, so I'm just going to give you a quick indication of liquidity here. Okay, so this is the dollar index over here. Okay, so this is basically telling us the strength of the dollar. Okay, so if we look at a 1 hour time frame, okay, this was actually an expectation I had of the dollar and the reason why I sold and bought euro last week when I did for day and scalping. So if we look at this over here, I'm just going to make this line blue and I'm going to put some X's over here so you can see where liquidity is. So on this move to the downside over here, this is a swing high. So above a swing high of price lays liquidity. Why does liquidity lay there? Well, as price moves away from this swing high and starts to break lows, retail traders are told that you put your stop loss above a swing high, okay? As well as if people are expecting price to break out, then they're going to put a buy stop. So there is liquidity in both forms there, okay, above this swing high over here, okay? So when price comes there and takes this liquidity from this move to the downside, we can expect reaction off there, okay? There will be a difference in liquidity. Some liquidity with lots of equal lows will have a larger run against the trend. So if we look here and we pull this across, this large move upwards thrust. So if you know anything about Wyckoff, it is UTAD, upward thrust after distribution. That is what UTAD stands for, which is outside the scope of this teaching right now. But just to give you an example, UTAD is upward thrust after distribution. So this is liquidity sitting over here. Price rallies. This is upward thrust. This is momentum. They are targeting. They're running out this liquidity. When they ran out this liquidity, there was no more momentum because they had then sold. over there. And we can actually see that on the Euro USD, because obviously it is a dollar-based pair. So on Friday, when they did that, Thursday and Friday, when they did that, this large move from this bottom. So there was this large move over here. And when it bottomed over here, you can go and look on your own charts. But basically, when it bottomed over here and started to move up, which is in line with this liquidity over here being taken over here. Okay. So when liquidity gets taken, they will generally run it down to the other side. And liquidity can be in the form of many things. It can be equal highs, equal lows. It can be closing price. It can be many equal lows as well. So if we look at an example over here, here we see closing price liquidity over here. So where there is equal lows, price is bouncing. This is a retail support level over here. So if you know anything about support levels, this is support. Price targets the support. Okay, this is not support. No such thing as support. Price will target support over here. And I can show you another example of higher time frame liquidity. So here is GU. Let's look at a monthly chart. What happened on GU? Well, if we look closer here, this is a double top formation. Why is it a double top? Well, closing price is double top over here. This is a double top. Why is it a double top? Look, well, closing price has made a double top on monthly. This is equal highs. So this is liquidity. When they raid the liquidity on a monthly time frame, there is no more upward objective. So the trajectory is downwards. And what do we get? Monthly order block created over here. Bearish on GU. Where can it possibly go to? Next monthly order block, which is what I told in the chat many months ago or weeks ago. I said, once it raids this liquidity, we can expect a sell-off. And why? Because of this equal highs. Higher time frames have closing price liquidity like a monthly and a weekly. It's not always about wick liquidity. Closing price liquidity on a higher time frame is important. So when you say higher time frame, it's monthly, weekly, daily. Closing prices liquidity. When you go to lower time frames, 4 hour, 1 hour, 15 minutes can be closing price liquidity and wick liquidity, equal highs, equal lows. In this example, it's a monthly chart, double top, equal highs, raids the liquidity, runs it down. Why does it do that? Well, breakout traders, people who sold many months ago, institutions, hedge funds, all have buy stops, sells over here, stop losses here. So they raid the liquidity and they run it down. They don't want to take those people with them. All the people with large money, institutions, banks, central banks, federal reserves, all of these entities with more money than everyone else, market makers, will run money down. Trade going against them. No one wants to be in a losing trade, not even hedge funds. So that's why they take liquidity. There has to be buyers to meet the sellers. There has to be sellers to meet the buyers. So all the buyers were sold to, because there, for every opposite transaction, there is another transaction. So when the market makers needed to sell, they needed someone to buy. Or when they wanted to buy, they needed someone to sell. Simple as that. Okay, we're running out of time here. I'm sure everyone's learning something. Darren, how do you combine LSB and OTE to get better entry? Okay, so let's just see if we can quickly get an answer to that. So again, over here on this specific, if you look back in the video, this would have been LSB on the 15-minute chart over here. Okay, so based on the entry technique, there's your LSB over here. Last step broken. 15-minute order block or breaker that gets traded through using the entry technique of the IPLs to the body. Here you can see 2 confirmations to take the trade. Retest the LSB, come into a premium price on the lower time frame to make your sell order over here. Okay, Let's just see on that 15-minute example. Here would have been our entry onto USD CAD for the buy. Here would have been our LSB over here. So when this 15-minute order block or last step broken gets created, traded through, price retests this area over here, which is our LSB. Well, then you could have entered there if you missed the trade using the entry technique, using the IPLs over here. Prosh, mitigation blocks is possibly something I will release a video on in the future, but it is outside the scope of the teaching because I have not shown any mitigation blocks on this YouTube channel. So it would currently be outside the scope of this teaching. And it would confuse people because I would need to go into a greater level of detail. But a mitigation block is an exchange of orders, basically. They are exchanging sells for buys and buys for sells. That's a mitigation block. Okay, lots of questions, but I don't have enough time, so I need to start wrapping up here. Unfortunately, I will copy and paste all these questions to take it into another session sometime.